Here's a different retirement question for you. Not how much have you saved, but if one decision can impact your taxes, and that tax change impacts your Medicare, and that Medicare change alters your income plan, who's actually responsible for making sure all of that lines up? Because I met with retirees this last week who hired good professionals and still ended up paying the price for the disconnect.
In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Welcome into Eye on Retirement. I'm Matt Goolsby, and I want to slow this down a bit because what I'm about to describe, it's not rare, it's actually the normal. Most retirees are told to build a team, so they do. So they go out and hire maybe a financial advisor, a tax professional, sprinkle in an estate planning attorney, and eventually probably someone helps them with their Medicare choices. On paper, it looks responsible. But here's what no one actually tells you. Responsibility is not the same thing as coordination. I recently met with a couple, let's call them Tom and Linda. They're sharp people, disciplined savers, no wild spending habits. They assumed that because they had professionals in each area, each lane, the big picture was covered. Well, it wasn't. An investment move probably could trigger taxes. Those taxes pushed income higher. Higher income, it increased their Medicare premiums. Medicare premiums reduced their net cash flow. And the cash flow stress changed how distributions were taken. And here's the problem. And no one owned the chain reaction. Each professional, they did their job, but no single professional owned the outcome. So who became the coordinator? That's right, Tom and Linda. They were expected to know what questions to ask the advisor, what to tell the CPA, what consequences to anticipate, and what not to change without asking first. That's not planning, that's project management without a blueprint. And this is where retirees deserve an honest question. What are you really paying for if you're the one connecting all the dots? Because retirement is not one-dimensional. An estate decision can have impact on taxes. A tax decision can certainly impact your Medicare premiums. A Medicare decision can affect your income. And an income decision affects risks and longevity. Yet most retirees are handed these group of professionals who operate in standalone silos, and while they might be competent, maybe even well-intentioned, but the big challenge is they're disconnected. That's the real risk in retirement. It's not the stock market. The real risk is fragmentation. It's having multiple advisors and no single process for making sure the plan actually works together. The most important part, Tom and Linda, they didn't fail. In fact, you could say they didn't even do anything wrong. They simply didn't know what questions they were supposed to ask. And that's why retirement works best when coordination is built into the process and not simply just dumped on the retiree. It's when responsibility is clear, when the communication is intentional, and when your spouse doesn't have to step in one day and take a guess at how everything works. That's what we're going to be unpacking today. So coming back after the break, I'll be joined with Gerald Eidelman. He's one of our estate planning attorneys that we work with Eidelman Law Firm. He and I are going to talk about the retirement planning coordination challenge and if how you miss one factor, it could result in major losses for your estate. So stay tuned. We'll be right back after this break with more Eye on Retirement.
Out on the water, there is a moment. Perfect synchronization. The team working together in harmony to reach their goal. Now, imagine finding a team of financial professionals to help run your course down the river of retirement. Market Advisory Group is that team. Financial advisors, tax professionals, estate planning attorneys, and Medicare advisors. All in the same boat. If you don't have a team like this in one place, it can become a hassle to relay information between them. When you come to Market Advisory Group, we bring everyone together for you. To get you answers in real time. To help make sure you don't miss something that puts your unique plan off course. You shouldn't be the one doing all the work to keep your retirement on pace. You should have a team in the boat with you. Your voice telling them where you're at, where you'd like to end up, and how you want to get there. And at that point, everyone falls into sync, all pulling in the same direction, toward the same purpose. Your retirement's financial security. We are Market Advisory Group, proud sponsor of Shocker Rowing.
Well, welcome back to Eye on Retirement. Earlier, I was talking about what happens when no one owns the big picture in your retirement plan. So joining me now to continue that conversation is Gerald Eidelman, estate planning attorney with Eidelman Law Firm. You know, Gerald, you and I have seen this happen many times over the course of many years. Most people assume an estate plan is a document problem, but the cold reality is it's a coordination problem. Wouldn't you agree?
Yeah, that's right. I mean, the documents don't control the outcomes. What people do with them do. Beneficiaries, titling, tax rules that contradict the state plan, powers of attorney that are not working and they are only working before death. So most state plans fail not for lack of paperwork, but for lack of planning and coordination.
Yeah, so I want to touch on that lack of paperwork. You and I have seen many times over where someone might have an estate plan, but the coordination gap there, whether they forgot to update a beneficiary, whether they forgot to retitle an account, whether they haven't updated their beneficiaries and it blows up their estate plan and it has to go through probate.
That's right.
You don't, an estate plan is not something you just get done, throw it in a drawer and forget about it.
No, and it shouldn't be. And that's part of the problem of some of these trust mills where, people go into these classes, they're sold into a trust program, and basically they get an attorney they have no close relationship with. It might be in another city. They are provided with a set of documents to sign and given a bunch of instructions that they don't necessarily know how to follow or follow themselves. And then that's just basically a bunch of paper, because when they pass away and if they haven't done everything that needed to be done, then the plan is not going to be effective.
So a plan can be legally, call it valid,
Correct.
but still fail the family.
Oh, absolutely. Absolutely. I mean, that happens all the time. Biggest thing is people leaving things outside of their state plan. We have people who buy property and forget to title it in
Or
the
I'll
trust
take care of
name.
that later. Or I'll take care
That's
of that later.
right.
And they never
Yeah.
get around to it. And then that causes big problems.
Yeah, because then you had to wind up going to probate. And if you set up a trust plan, you wanted to avoid that. That was the very thing you wanted to avoid for your kids.
Someone told me the other day, I liked it. It was a very simple analogy. They said, do you want to pay me now or pay me later?
That's right.
And the pay me later is
It's more expensive.
More
too.
expensive. Yeah, it always is.
Absolutely. Absolutely.
So even, let's call it even a good estate plan can collapse if it's not aligned with the other parts of your retirement plan, say the taxes, account structure, and real life family dynamics. So
yeah.
what are some of these other instances of an estate plan not being good enough, as in where you've seen in your client meetings that sounds alarms?
Well, actually, I have a client, a couple of clients, and we had set up a estate plan to do an asset protection trust. The entire purpose was to protect their assets as they got older and maybe be in a nursing home or some other situation like
Medicaid
that.
spend down.
That's
kind of
right.
thing. Okay.
So we had a plan and we put it into motion. Lo and behold, without my clients ever speaking up, their financial advisor had a whole different plan for them. Not a plan about how to invest money, but a plan how to use all of their property they had that I was trying to protect for their later years. So I got into basically a contest as to who knew what they were doing. And eventually, in parts, I won in part and I lost in part because I couldn't protect everything because the financial advisor had a different plan for them. Had I known ahead of time, I could have done things differently.
Almost like there's one steering wheel in the car for a reason.
Yes. This is not a driver's ed course.
And so this other professional was really had a different, I don't know if you want to say philosophy, but I guess we could use that word, philosophy. They had a different outlook on what was best for their client, but you're looking over here from the legal lens saying, well, this is how we protect this is how we protect this, and your financial advisor doesn't know what they're doing.
Right. Yeah, I couldn't say that quite.
Well, I can.
But I mean, and that was basically what it came down to. So they split the baby and they put some things in the trust, some things they left out of the trust, which basically are now completely unprotected.
Exposed.
Yes.
So an estate plan shouldn't work in theory. It needs to work on the worst days of someone's life.
Absolutely. If you if your plan is not set up right from the beginning, people need to understand that it isn't just about the paperwork, but it's about the preparation. It's about having already, kind of push that out into your mind as to what is it going to take to execute it? What steps? Do you have the right people in place? Is there somebody some people sometimes put people that they have no interest in being in that position. So sometimes this is all part of the preparation, whereas the documents might say one thing, the outcome might be a completely different situation.
Well, I appreciate you helping us learn more about estate planning and how it's not just about the documents. And thank you for helping people understand it's not just about the paperwork, it's the preparation. And speaking of preparation, do you feel prepared enough for retirement? Or are you confident that your current plan is keeping up with the ever-changing landscape that is retirement? So if you're feeling that tension, if that uneasy feeling of the unknown, we're here to help. And that first step is scheduling a 15-minute phone call with us. And you can do that by calling 833-44-CORE4. It's really easy. It's just a 15-minute chat with us by phone. If you don't want to schedule that on the phone, you can actually go over to retirementhelp.com and do that. But that phone number again is 833-442-6734. Or again, visit retirementhelp.com for all retirement things. Well, when we come back from this short break, Trey Basa with Market Medical Insurance joins me to explore a topic we all love and adore, healthcare. Stay tuned. We'll be right back with more Ryan Retirement right after this.
Retirement is supposed to be exciting, the reward for decades of hard work. But for many, it starts with a flood of questions. When should I take Social Security? How will taxes change when I stop working? What do I need to know about Medicare? And what happens to everything I've built when I'm gone? Retiring isn't just about leaving work. It's about stepping into a whole new season of life and making sure you're ready for it. That's why there's retirementhelp.com, a free online resource built specifically for people just like you. Clear, trustworthy information on the decisions that shape your retirement. RetirementHelp.com is here to empower you with the resources and education you need to retire with ease. What sets RetirementHelp.com apart from other resources is how we view retirement planning. We believe it takes a team, because taxes can affect Medicare costs, and finances can affect estate planning. We take a holistic approach to retirement, so you don't have to bounce around like a pinball to get your questions answered. We have articles designed to answer questions you may have, webinars that dive deeper into topics like Social Security and taxes in retirement, videos, TV shows, and podcasts exploring real-life issues retirees have run into, as well as daily updates addressing changes in the retirement landscape. Don't let doubt keep you up at night wondering if you're ready or not. Visit retirementhelp.com today and start planning the retirement you deserve.
Well, welcome back to Eye on Retirement. You know, we've talked about taxes and estate planning. Now I want to focus on the other area that I feel is so important in retirement, and that's healthcare. So joining me is Trey Basa, health insurance advisor with Market Medical Insurance. Welcome in, bud.
Hey.
So Trey, retirees often think of Medicare as just the premium decision, but you and I both know it's much bigger than that.
Oh, yeah. People come in wanting to know, what's this going to cost me? What's my bottom dollar for all of these different policies? And that's just the surface level.
One component of it.
Right. We definitely take it into consideration, but we need to talk about, and something that you always hint at is just the tax consequences that can affect those premiums, right? People might have inheritances, extra distributions causing an increase in their income, which is going to cost them hundreds, if not thousands of dollars more in Medicare premiums down the road.
So when people maybe get left a retirement account from their mom or their dad or maybe brother or sister, from whoever, that inheritance, if not handled correctly, could trigger higher Medicare premiums?
Indeed. And not even right then and there. Again, it's a 2-year look back period. So they get the inheritance this year, and 2 years down the road, that's when it's going to hit them.
And sometimes we can do some things, whether it's managing the withdrawals, whether it's writing a nice letter to Social Security. And that's probably not going to be there forever. But there's different ways to mitigate these strategies or these implications, and using these different strategies to mitigate that. But let's now talk about how I think a lot of people don't review their plan every year, like their prescription drugs, and then when those changes happen, it surprises them.
Right. Whenever they're just living out their retirement, their best years, they don't review their plans. Again, 1 year can change their whole plan, their formulary, their cost for prescriptions, and all of a sudden they're paying more next year than they did this year because they did not review their plans. Those plans change every year, and you have to be aware of all of those little differences.
So would it be safe to say that healthcare decisions don't live in isolation? They either support a plan or constrain it?
Absolutely. When we're talking about the giving a retirement plan life, you have to consider, what are you going to spend on your healthcare? Not just in the worst case scenarios, but the month-to-month costs of premiums, prescriptions, all of your policies while you're in retirement.
So as a financial advisor, I help people budget out and figure out, do they have enough money to retire? But if I don't have those healthcare costs included in that budget, I'm taking a scientific wild something guess.
Yeah, good save.
Yeah, right. And so this brings us full circle. When the healthcare, when taxes, the estate plan, and the income strategy are coordinated, to me, I see stress go down for the retiree. Wouldn't you agree?
I see it too. Absolutely.
And so they come in and they work with us as this team. They have healthcare questions. I kick them over to you. They have maybe financial or retirement questions. You kick them over to me. That's why we work together as this coordination. So thanks for sharing your insights on the healthcare and its impact on everyone's retirement planning. And for our last segment of Eye on Retirement, I'll be speaking with Jonathon McCoy, financial advisor with Market Advisor Group in one of our Kansas City offices, about the coordination tax and how you can help avoid it. Stay tuned. We'll be right back with more Eye on Retirement right after this.
Every client we work with deserves a custom-made plan to fit them.
We can take any situation that's thrown in front of us, look at what fears they may be trying to work through, and come up with very creative solutions.
We are unique to people that are seeking to try to have the complex things more simple.
We work together as a team. As an advisor, it'll come up with tax questions. It's great to have a CPA here in the office that can answer those questions and give them accuracy.
Market Advisor Group, proud to be local.
I need a place to go to see about my investments. Ask my friends if they know about holistic retirement. Everything in one place. Estates, taxes, and Medicare. People meeting face to face. Advisors to help me get there.
At Market Advisory Group, retirement under one roof. At Market Advisory Group, we're invested in you.
Welcome back to Eye on Retirement. I'm joined now by Jonathon McCoy. He's a financial advisor with Market Advisor Group in the Kansas City area. You know, Jonathon, I'm sure you've been listening to the show earlier. We've talked healthcare woes, estate planning fiascos. Now let's talk about this thing called a coordination tax. What's that?
Yeah, so this is thinking about all of the time, effort, money, frustration, and sleep that is often lost from examples exactly like what we've talked about here. Folks having to spend all this time trying to coordinate between multiple professionals in their financial lives, both from an estate planning, tax perspective, financial and investment management. And oftentimes you'll, as you heard from Gerald especially, you'll hear that these financial professionals have vastly differing ideas and vastly differing concepts on how your estate, how your portfolio can and should be managed. If those people aren't coordinating, it's going to cost you something. It's going to cost you what we call this coordination tax. And ultimately, you're the only one left to pay for it, right? It's the retiree. It's on your shoulders. These are your assets. It's your responsibility to be a good steward of them. But having that team together to help you steward through this process, it can be significantly expensive if you don't have that.
Well, and I think the best example is when you talk about expensive, when you go to your advisor and you say, hey, I need a withdrawal, I need $10,000. And if there's a way, whether it's through a Roth, whether it's through your after-tax money, your non-qualified investments, or your traditional IRA, if they can blend those withdrawals working with a tax professional or even coordinating with your Medicare person, they can help limit those surprises that can trigger IRMA surcharges and maybe even higher tax brackets, creating this tax health spiral in these withdrawals. And that coordination tax to me is someone that's not being able to look at your overall scenario. And more often than not, we find that that's left up to, or that responsibility is left on the retiree's shoulders. So this coordination is really, when you're working with a coordinated team, it works as a hedge. Would you not agree?
Yeah, you're exactly right. And it's built over time, right? I mean, these relationships that we have with financial advisors, it takes time to build the trust. It takes time to see the results in the portfolio and investment management. But so many people are looking at their retirement planning from such a narrow scope of the investment performance that they're not seeing all of these other things that could be being built up over time. That's what we see so frequently here with Market Advisory across our team, is that these plans come together over time. It starts in the earliest years of retirement so that you've got some of these assets positioned in more diversified tax structure, more diversified asset structure. So you've got during up markets, down markets, high tax environments, low tax environments, high income situations. Trey talked about, when people receive inheritances and the effects that can have on your Medicare premiums. All of these things are fluctuating at all times over a long period of time. And you're left to deal with this. You're left to juggle with this year in, year out throughout retirement. And you don't want to wind up, and at least folks that I talk to don't want to wind up 15, 20 years down the road looking back saying, coulda, woulda, shoulda, what did I miss? Now I'm left holding the bag because I've not gotten some of these diversified tax management and portfolio management and healthcare management strategies in place.
So I guess to simply say it then, when these 3 areas or 4 areas don't talk together, the client can get hit out of nowhere with this coordination tax, and that's not a tax to the IRS, but it's maybe in lost time, in unnecessary stress, and possibly even eroded wealth.
Exactly right. And we see that the eroded wealth often is kind of the big headline item here, but these stress factors, these time factors, these just feeling like you're left not knowing what to do or have very few or no options. That's where we find people a lot of times just feeling stuck. And quite frankly, that's why a lot of folks come to talk to us, is because they found themselves in this position where they're stuck, where they've seen a family member or a friend go through it and they don't want to see themselves go through that situation. Sometimes you're not finding out about these things until it's too late, and then it becomes even more expensive to deal with it. Like you talked about earlier, pay now or pay later.
Well, and briefly, I think you and I have seen this over the many years of our career. Sometimes people have to experience the pain before they want to make a change. They don't really get proactive about making the change until it costs them.
Yeah, that's why it's important to get this team in place up front, earliest years of retirement, so that you are positioned best as possible for the future.
Well, thanks for sharing with us today, Jonathan, about that coordination tax. And that coordination tax, again, it's not a tax you pay to the IRS. It's a tax that can cost you in lost time, maybe in eroding wealth, or just frustration and lost sleepless nights. You don't want to have that. So I want to give you the takeaway for today. A siloed plan is a brittle plan. And when I say siloed, you think about that. We're in Kansas, we're in Missouri, we're in the Midwest. Those silos, they're great until they're not. And we coordinate so that when life gets complicated, your finances, they can remain simple. And speaking of simple, all you have to do to start this process is take step one. And that step one is a 15-minute, no obligation Core 4 intro call. That 15-minute chat by phone is designed to bring clarity and coordination. You can schedule your 15-minute step one by calling 833-44-CORE4. That's 833-442-6734. Or go over it again to retirementhelp.com. I'm Matt Goolsby, reminding you that we're here to keep an eye on retirement.